Hi, and welcome to this transformative session on AAA, where we break down the complexities of audit engagements into actionable insights for finance professionals and students pursuing global certifications like ICANN and other top-notch professional certifications. My name is Gabriel Josiah. In this session, we delve into the core purpose of an audit as defined by international standards on Auditing 200, the golden standard for assurance engagements, and explore how audits safeguard the trust of stakeholders by ensuring financial statements are true, fair, and reliable. Whether you are gearing up for exams or advancing your career, this is your gateway to mastering the principles that underpin professional auditing. Let's dive in and make your journey to excellence an engaging one. Let me share the study text and let's look at this fundamental very, very briefly. Gone mini now as usual, and we're looking at Unit 2, concluded on Unit 1 in the last video. We're looking at the meaning of audit and audit-related services. So the section we'll be looking at the audit, the meaning of audit. The second section, we're looking at audit-related services. So this first section covers audit. Now, the IAC 200 states that the purpose of an audit, which is a form of assurance engagement, is to enhance the degree of confidence of intended users in the financial statements. So that confidence provides comfort that nothing has gone wrong or nothing is wrong. So an audit provides that clear assurance or clear comfort, call it confidence, that nothing has gone wrong or is wrong with this financial statement. And that is what the purpose or the objective of an audit is all about. So the International Standards on Auditing 200 state that unequivocally. This is very important. This is achieved by the auditor expressing an opinion on whether the financial statements of an entity are prepared in all material respects in accordance with applicable financial reporting framework like the IFRS or the US GAAP, whichever standards apply to that region. Now that opinion must be expressed based on the financial statements prepared in accordance with the framework. In our jurisdiction, the IFRS is the applicable financial reporting framework used for financial preparation of financial statements. So a financial reporting framework may be provided, for example, by a country-specific legislation plus international financial reporting standards. So the country-specific standards and regulations could be added or aligned with international financial reporting standards. The audit opinion typically makes reference to whether the financial statement gives a true and fair view. So the trueness and the fairness in the view of, or in the opinion of the internal or external auditors matters, or is fairly presented, and the financial position and results of the entity is true and fair. So the audit opinion typically provides and makes reference to this. Audits are long established form or established formalized processes, closely regulated by law and professional practice. So audits have been in vogue. It has been around right during the dark ages. Audits means hearing, audio. It came up from the word called audio, and it means to hear. But with civilization and globalization, reports are prepared on computers, so you don't need to hear, you just need to review the financial statements. And audit is long, and looking at the history of audits, it is regulated by law and professional practice. This is important. Audits were developed because of the separation between the owners of the company by the shareholders and the stewardship by the directors. So there's a separation between those that perform the core activities or day-to-day running of the company, who are called the directors or the stewards of the company. They are separated from the owners or the shareholders, stakeholders of the company. So audits are necessary to bridge this gap, to give comfort, confidence, and some level of assurance to the shareholders that don't run the business, that what the stewards and the directors are doing is right. That's what the audit is all about. So in order to protect the shareholders from incorrect or misleading information by directors, an audit is designed to provide a high level of assurance to the users of the financial statements. So misleading information could affect decision making by the owners of the company or the shareholders. So it's very important that audits or these necessitated audits for that level of assurance to be provided to the users or the shareholders of the financial or the company or the entity that is being audited. This is very important. So the link on the screen is a case I want to describe. I'll practically apply here on this short explanation I've just provided on the need or the meaning of audit, like I've spoken to very, very briefly. So I want to illustrate the purpose and importance of audit as outlined in ISA 200, considering this particular real life example. In South Africa, the auditing firm Deloitte faced scrutiny following the financial collapse of African Bank in 2014. The link is on the screen. You could verify that. You could Google it also. African Bank's directors provided shareholders with financial statements that failed to accurately reflect the bank's deteriorating financial position. Deloitte, as the external auditor, was criticized for not identifying and reporting on critical impairments and other financial risks in the financial statements. This incident highlighted the essential role of auditors in ensuring the reliability of financial information provided to stakeholders. A lack of rigorous auditing contributed to significant financial losses for shareholders and impacted public trust in the financial system. So in this case, underscores the need for auditors to deliver high quality assurance, as our opinions or auditors' opinions form the basis of users' confidence in financial statements. So by adhering to ISA 200 principles, auditors ensure that financial reports provide a true and fair view. That's the key word or key phrase, true and fair view, enabling stakeholders to make informed decisions. This is very important. So that's in Africa. Looking globally at a similar lesson that emerged from Enron's scandal in the early 2000s. Enron's directors and auditors, Arthur Andersen, manipulated financial statements, ultimately leading to the corporate collapse and investor losses. The fallout led to regulatory reforms like Sarbanes-Oxley Act, which strengthened audit processes and emphasized auditors' independence to protect shareholders from misleading financial information. So these examples looking at African Bank in Africa demonstrate the critical role and the global example also of Enron of auditing in bridging the gap between the company directors' stewardship and shareholders' reliance on accurate reporting or accurate financial reporting as envisioned by ISA 200. This is very important. I hope these two examples resonate with you. I didn't provide the link for the Enron scandal, but you can Google it. It's all over the internet. That of African Bank, that Deloitte handled this. The link is on the screen. I can provide the description. I can provide the link in the description to this video below for you to check and also read wide on what happened and a detailed description of the case that transpired. This is to help you understand the essence and the essentials of audit. Very, very important. Okay, that wraps up our session on the fundamentals of audit. Remember, audit are not just about compliance. They're about fostering trust and transparency in financial reporting, a cornerstone for global business. Okay, if you find this content valuable, don't forget to like, share, and subscribe to my channel for more expert insights tailored for finance professionals and certifications students engaged in worldwide. Let's continue to elevate your skills and achieve success together. Until next time, keep aiming high and making an impact. See you in the next video. And until then, bye for now.